Best people, it's the Market Sniper giving you another update. That's right. There's been a lot happening. So first of all, CPI numbers came in today and they undershot. CPI month on month was 0.2 on an expected 0.3. Then the CPI year on year, so taking 12 months back, comparing them to, is projected 3% up on a year ago. And then the core CPI, which is the most things you absolutely must have, so it's a basket of goods of essentials, is 0.2% up month on month, which is an annualized Chinese mathematics times 12, 2.4. So that was under expectations because the market expected 0.3, got 0.2 on CPI, expected 3.1% year on year, got 3%, expected core at 0.3 and got 0.2. So there was an undershoot. So everyone getting excited and saying Fed's won on inflation, that everyone's got into this hyper stagflation mindset and all of this, and in actual fact, inflation, they're starting to get the bunting out, inflation is being killed. And this is typical of all major inflation cycles. And there's a couple of things. We're going to be talking about the dollar today in this video and the reasons and the drivers. So I had an exchange with George Gammon, give him a shout out, give him a sub. Good man, always trying to get to the truth of the matter of economics, but a slight difference of opinion, which we'll get into as well in terms of how things are going to go panning out. He's calling, no one said this, but inflation is being reined back and won. So the three reasons. Look into the eyes, listen to this. The three reasons. It didn't start today, this dollar set off. It actually started last week, Friday. It started after the payroll numbers came in and the great labor excuse for hiking, and it's not a recession because red hot labor market, that fell apart when we undershot on the expected payrolls number last week. Yes, indeed. And then also the Fed itself had done a backpedal and not raised rates last opportunity. So A, no increase in interest rates. B, undershoot on their reason for tightening and not a recession, the labor market. First time, 14 in a row, and then the 15th big miss. And now the CPI coming in below. So what does this mean? Everybody calling peak inflation, everybody saying that's it, it's going down, down, down. So you get the peak inflationists, and to some degree, I sense a little bit of that with George. Just for the record, the non-farm payrolls was expected at 224 and was at 209. But you were setting up for a beat because the ADP number had been a lot higher just the day before, which is kind of a proxy data release, a small sample that implied it should at least meet, if not well beat. And in actual fact, you came in number. 3 data points, all showing that the economy is far weaker than they say. And what has this done? Well, at the same time, you had bond rates that were creeping up until the back end of last week. And that's putting the pressure on a number of things. A, they need the debt to devalue. We'll be going to the charts right now in this video. You will see that exchange with George, how we have a slight difference of opinion. That's good. It's a healthy thing on where it's going. Also in this video, we're going to show you the dollar and all the cross currencies, all the ones we wanted to trade it short against, the Norwegian krona, the Swiss franc, and everything else. In fact, let's get straight to the charts and that discussion. So this was this morning, year on year down to 3%. In the past, CPI has gone from 9.1 down to 3%. Most people got this wrong. Why? We don't think we got it wrong. It's absolutely expected, and it's not anywhere near the end of the inflation. It's the first pullback in a lot longer. In short, we actually see rates longer term going higher. We have called for the 40-year end in debt, which means higher and ever higher rates in a staircasing manner with regular pullbacks along the way as you go up. Why did no one see this coming? No, you absolutely do get. One of the key things that I think George isn't counting for is basing effects. What are basing effects? Well, if you had an environment where inflation, let's go nice fat cokey draw on top of George's Twitter account, let's say that's the 2% level of inflation, 2% done like a Z, super sexy, transgender pink. If you're basing here and then you have a sudden move up to 9, let's say that's 9%. There we go, another sexy letter, 9%. Up there on your basing effects, what in fact George would be using his whiteboard and it would look a lot neater than this, by the way. 9%, that's a super spike. When you compare 9% to the 2%, rounded top 2, maybe I should use a slide stylistically draw like that, 2%. What then happens is you're still going up. Goods are still getting more expensive. Just the degree of acceleration is down, the second derivative as they call it. So if you've now gone up a further 3% here on that base year 1 year ago. Now I'm not sure it was the absolute high. I think it was 9.1% a year ago. 9.1% a year ago. So you're talking about roughly 9%. And now you're saying we're winning. It's only gone up another 3 here. Here's your sexy 3 draw. You've gone up another 3% where this was your new base. This is your new base. This is not a victory against inflation. This is not a victory against inflation. You've gone from here at around 2 up to 9% more than that, what you were when you were doing 2%, which is a massive climb. That's why I'm showing that so steep, to now 3% in a year. Basing effects is you are comparing this to a super high pump spike that occurred from the resultant effects that trickled down through the stimulus that went out to everybody in the years following the events of March 2020. And as a result, you are now a year further on comparing with that peak high, and you're still 3% higher off a localized, very high spike. This is not inflation victory. What it is a slight decrease in the rate of change of prices. A slight decrease in the rate of change of prices. This accelerated far better. So if you look at an acceleration curve of, say, a Porsche Turbo going through the gears, it goes something like this. First gear change, second gear change, third gear change, fourth gear change, fifth gear change, and sixth. So eventually you get your 300 kilometers an hour. The steepest part of the curve actually occurs in first and second. But you don't celebrate the loss of speed because the curve between second and third is not as steep as it was at first and in the gear change from first to second, and that the rate of ascent between third and fourth is flatter. So you get this convexity. I didn't draw it so well there, but you get essentially this convexity that occurs that is still showing ever heightened rate of speed, but just the acceleration is reduced from those individual gear change events that as and when they occur as you declutch and change up. So this is what's actually happening. There's a basing effect. You're comparing to a very, very strong high point, and given how far you went, you aren't building another 9% on a previous 9%. Because that's already caused so much shock to the system. There's a lot less consumption going on, there's a lot higher rents being paid, there's a lot less disposable income, etc., etc. But prices are still going up, just less fast. In the same way as you hit the 300Ks when you're hitting 6th, 7th and 8th gears, depending on which model you've got, not when you're in first gear. So you are continuing to get worse, just the rate is slowing. So basing effects is the point number one about that. George's point was thinking we need positive real rates. Too many people thinking we need positive real rates to bring down inflation. So he is going counter what Druckenmiller said. There's never been an instance, and I've repeated this statement, where you brought inflation down once it's gone past 5% with actual percentages that do not go higher than that current rate of inflation. Now what is actually happening is he's saying we don't need positive inflation rates. Well, you do. You will need for a part. It may not happen in part one. You get initial outbreak and you react. And just the fact that you react starts to slow the rate acceleration down, but is not actually changing the fact that prices are still going up. To actually get them to reverse and to get negative inflation, full-blown disinflation, negative inflation, you need to actually have the higher rates. All you're going to do by responding suddenly and so violently, and people have to remember, the Federal Reserve raced that curve up immensely. So the difference that you were behind compressed immensely. That brings the rate of ascent down, but it is not stopping it from getting ever more expensive out there. So you do, if you want to permanently stop, rein back, have a sustained period of negative inflation where you return the pricing somewhere back down to where they were when they were at 2% before the events of March 2020. You're never getting them back there. Forget it. You're not even getting them close there. But just to bring them for a sustained period back down in the direction, you need negative acceleration. That is braking. You have not applied the brakes. You've just allowed the acceleration therein to go. And the rate of ascent is reduced because the difference between the Fed's actual rates and the true inflation rate has closed because of their violent hiking. It has not gone, and I disagree with that point. You will to permanently put the nail in the coffin, and to do so for quite an extended period, because you've stimulated and created a runaway fire on a number of levels. People's expectations are rejigging. You have to actually keep the brakes for a sustained time. So if you've ever been, and I'm using a lot of motor vehicular examples, if you've ever been in, I was fortunate enough to max out Porsche Turbos, Lamborghini Gelatos, and various other things in a controlled environment with a banked curve, and you're with an instructor driver. Once you're hitting 180, 190, and he needs you to bring it down to right down to 50 or 60 to do the bank curve, you have to really jump on the brakes. He tells you, brake, keep braking, not hard enough, all the way, down, down, down. So you've done a speed run, and you get hyper-normalization of what 280 k's per hour is. You need to bring that thing right down, and it requires braking, sustained, almost like an emergency stop, to bring it down to 60 so that you pootle along at what you'd consider normal freeway momentum. And this is the analogy of what's happening. You will need, in my opinion, ignoring data and focusing on narratives, hyperinflation. So we are hyper-stagflation. This is negative growth and a weak consumer, but in an environment of stubbornly high cost to a greater degree than you ever experienced in the 70s. And you're only in the first phase of a much bigger book and story. It's too soon to start saying, here's your data we've won, 3%. 3% inflation on top of an already spike high number in a year is diabolical when you're in a goddamn recession and you're putting real pain on people's rentals. We'll show you some tweets on rentals, how the mortgage payments now to rentals has gone absolutely one of the all-time extreme highs. Now either those rates come violently down, I don't see it, the bond market is not showing that. Remember this, their key policy now is debt devaluation. Understand this. What is the Fed's true game? Not what they tell you, true game. Too much debt, they need massive devaluation. That means higher rates, loss of value of debt. Too much of it about. But how do they afford their payments? At some point they won't be able to. They're going to monetize it and you get a forced reset. You are not getting 40 years of slow unwind in the manner that you put it on. Unfortunately, it's not like that. Escalator up, elevator down. But while they're playing at fixing this game, this is what you're going to go through. They still need the devaluation of debt. And when they pull the bond rates down, which means a bit of a bid under the bonds, the other thing that then takes the loss of what is required will be the currency. You see currency and debt. And we've had this exact same discussion with the Japanese yen, with the Japanese at a more extreme case of trying to maintain the value of their bond market. Guess what? currency is borrowed into existence, yin and yang. You don't get the white teardrop without the black teardrop. You have the debt, you have the currency. That's the difference with gold, my friends. We will be looking at gold in this clip and showing you how it came alive against the dollar, but not that alive against other currencies where it had already made a marginally higher high. So actually we're getting a lukewarm metals in the mix of currencies with a super spike weakness in the dollar, showing it to be the ugly kid in the room right now. Third point George made, a misunderstanding of what caused the CPI to get up to 9.1%. Well, one of the things was the oil price that went up to $130. We called that top. It's tweeted, it's out. You can also see the case study in our website on all our oil calls right the way through. And the key thing about that oil price right now is it's starting to go back up. We warned while the dollar was holding some degree of strength that actually there could be weakness with the consumer dying on the oil some time ago. What's now happened is this whole cycle is reversing. So the dollar is taking the crash. And that allows the US debt still to devalue, even if the yields are going a little bit down and the value in dollar terms going up. If the dollar is losing percentage points, massive chunks each day over a sustained period, we call for the Dixie. And you mentioned it yesterday, the day before yesterday when you're watching this video, 97 on the Dixie, and it is disorderly quick. You've had the three events we listed. Remember, the no rate hike, the undershoot on labor market, the undershoot on inflation stats on a year-on-year basis compared to a very high point previously. So the fact that you slowed the acceleration is not the time to celebrate victory at all. And you will get a second surge in this. Why? Because in the point we make back to George, they will start to import it back. Because with the oil price now going back to 75, where it traded as low as 67, that has an effect and starts to see Americans delivery, packaging, everything. The oil is in everything. He says, not trying to dunk on people. It's okay to make an argument. You don't have to apologize with it. I just don't agree with everything that is being said there. So how did we counterpoint this? What charts were involved? So let's have a wee look. Check it out. Fung Soul Brothers talking to our boy George Gavin. So this is the one chart that I wanted to highlight. So this is mortgage payments relative to, that's your 0708 rentals. Which is the more affordable? Now rents are quite a lot more stable. It's the fat blue line. Mortgage payments for people that are changing properties, even if you get a fixed, you've got to choose your moment very, very well. People that are buying in now, it's 40% different. Now, let's just be absolutely clear. Rents are going to go up. BlackRock, as homeowner to the Americas, is going to want them to go up. They're going to do just dandy with those interest rate hikes, of course, and you're going to see that being forced to effect. That, along with oil prices getting stronger, housing, energies going higher. Good luck, core CPI. In 6 months, 1 year's time on this dollar, that is absolutely falling. It's time to show you a dollar chart. So let's do that. Let's see what we've got. So I'll start with the euro dollar. We had a falling wedge. We made the very comment, there's a bid coming in here, marginally lower low there, and failure to make a new low, and the breakout on the euro at the 108. That occurred on the live trading day with us. Non-farm payroll in the second half of the session. Actually, it didn't immediately kick. It was while we were doing crypto, and then our alert started to buzz. You've got the fatally flawed euro smashing it up from 108 through the top, what we thought would be a rising wedge higher, really in a most disorderly fashion. It's also in the Dixie. The Dixie is the chart that most of you are used to seeing. So let's bring that baby up. So this is a screenshot. It's actually got worse. We drew this structure to show a squeezing, flat-bottomed, what you would consider a triangle, an inverted HVF that triggered with real momentum. And in this, you will see that this is a disorderly descent. The blue line is your $100, the Mexican peso border. You're going in the opposite direction of the immigrants. You're heading south at a disorderly rate. We're going loco down to Acapulco, my friends. We're going south, and it's at the 97 parallel on the geometry just of this chart alone. So that is a most disorderly descent from the dollar, and that's how it looks now. Let's just pull this through for you to see that. That is brutal. It is absolutely brutal, and it is one directional. And the 100 now looms. It is quite typical in price behavior that you get wind-up structures to take out really significant events. We teach this in our program. Very first link below in the description. Click it and book a call. You'll watch us implement it, and practically inside as we daily implement the Hunt Volatility Funnel method on the price markets. That was your perfect entry up top there. We started talking it at 103. Your non-farm payrolls day, which was Friday, the live trading day, gave you this huge candle where you gave up the two blue lines, the 103 and the 102.5. Then you went down, you've smashed this low, and you've hyperextended already. You've run that low and that low. My friends, this is a break for the border. And we warned the crypto guys first, and it's been disappointing performance out of cryptos in lieu of the dollar weakness so far. We'll be checking in on gold. Gold started to turn against the dollar in a much better way, and that's live and silver up as well. So the big gods of the anti-fiats have now stirred. Will it trickle into the cryptos? We remain to see whether that's the case. So this is the dollar index in terms of its moving. We gave to the community a couple of trades, particularly, for example, with the oil getting a little bit of a bid again. We gave it the USD NOK. So we'll show you that. We also highlighted the turn on the Chinese renminbi. We did the Asians with you last time, and you've seen since that video that move since there. This is all the work that we've done. Big upside HVF way down there, big reversal head and shoulder, and then a reversal to the upside in green that broke over there, that gave you that big move. On the lower time frames, this is what we saw. We said this fella's going to break. Left shoulder, head, and right shoulder. You could have got in early on the basing line. Look at that spill, all in your favor. And you don't just make targets, you could pull back for a long time. Remember, euro, or let's say the Dixie, which is euro 52%, I think, Swiss franc. We'll look at the USD Swiss franc. The franc is your currency of the moment for strength. The USD Swiss franc is a tale of woe. And the British pound and the Japanese yen all in there to varying degrees on the Dixie. So you're getting all that. But you're seeing the euro. Let's just show you that live chart now. You've popped out. This was an incredible falling wedge to have played. Last time, you were rolling over. We called this rollover. We said 3 tap outs, marginally higher highs, failure to make a new high. We spoke of the rounded convexity at that level, which was 110s. So the 110s was proving a bit rich. You have smashed the 110s. Don't forget, it wasn't that long ago during the dollar strength period that you got a parity run. Small reminder, guys. Right down there, small reminder. Wow, what a turn this has been. Again, dollar index on the macro. If we go and have a look for you on the dollar index, this hasn't updated with the previous close. So that's the full close live, the daily dollar index, but we'll take you on the monthly. This is by the time you actually get the new day, it'll be down here. It's actually run those two lows. It's on its way, log scale please, there we go. It's on its way for that 97 dip. This is a real loss in the dollar in terms of power. Don't forget, we called this breakout to the upside for 110. And it tapped out a short segment ghost touching 115 in this channel and basing out there. You're looking at, after coming out of that long falling wedge, 97 being in and around over here. That at this current rate would be quite a steep decline. At its current rate, quite a steep decline. It's taken that to stop stop the debt markets from going up. And I'm afraid to say they are in a position, and this is what I was sharing with George, that debt markets are going to go higher. Debt markets are going to go higher in our view, in terms of yields. Yes, they're getting, the values are going up and the yield came down, but in terms of yield, we will see 4.8. It's part of a macro change in trend. Good people, that started a long time ago, as we called, this is a secular change in trend. It is huge, and most people are not estimating it. The fullness of this change in trend. That was your low. That was continuation. There was a minor continuation there. That was the final top. Now you're in another continuation. We feel that you're going to make that level before having another rest. Don't forget, this is log scaled now. The same with the 10-year. So with the 10-year, let's have a little look at this fella. This is a very rounded bottom. Again, a trend change. We got this upside HVF. You smashed it and you made new highs. Well on its way, all the way out of the structures. Keep on keeping on. Continuation is the game. The macro trend is your friend. And the macro trend on rates is going to be higher in spite of this sell-off. We got this little fractal of an HVF that gave us the localized high over here. We'd drawn this some time ago when we'd watched it. And there it is. There you had that little break. And that's why you're probably having a small pullback now. These timings come in perfectly. Make the top. Make the top. Now you pull back. If that funnel survives, you end up with a cup and handle. That's how it looks to me. That's how it looks on a bigger time frame to me. This is not a reversal pattern, beautiful people. This is not a reversal pattern. You'll get some form of retrace and you will be back at this 4% line again. So when we drew this and we shared it with George. I don't know if he likes our technical drawings, our Picassos. We'll have to ask him. But what we were making as a point is that there is real debt devaluation. If you look at this, that's needed. It's absolutely needed. You can't maintain the value of debt when there's so much of it around. Scarcity and value are very much proportional things. An absolute abundance and proliferation and churned out every day, all day long en masse is not high valuation. And this is the W we see as dovetailing on the 4% neckline. You get a little bit of shouldering, you iceberged a tiny bit. That was the blow off top. During that period, by the way, you had the pension crisis on the UK market, US 10-year. You then went into this W bottom, which is basing out here, basing out there, rallied back up. You had the tiny little wind up to get you up there. And again at the 4, 2 localized highs, and you had the localized high here for your little left shoulder, your W head, complexity in head and shoulders taught by us, and a little dip back, and we expect a rally back up. You go, you guessed it, next level, 5%. Sorry, US home owners, if you're going to be buying in the future, not too far off, you will face rates similar to the 5% and the 4.75. What do you think that does for pricing? What do you think it does for consumer feel-good factor and wealth? Down, down, down. It's going to be hard. It's going to be hard. Eventually, you're going to have some corporations having some bank lending problems. Initially, when we have the inflationary element, the equity market goes up, and that's what you've seen. But when the debt starts to fail in corporations, then it becomes more acute. It becomes more acute and it becomes a real problem, and you start to have failure. That was the 30-year, how we carved it up, and that's also what we shared with George. Yes, you're having a pullback, but you made your first interim and you're getting a bit of a pullback, had a falling wedge, made a bit higher. This isn't going to be a ripper. I don't think it's going to be overnight. I had to draw it quickly. I only left myself so much space, but you're going to get up to 4.75. Why? And beyond that in time. But things will start to fail. When they get to a critical level, things will start to fail. Remember, Shadow Stats told you, you are not getting real fiscal reduction. You are not getting reduction on the fiscal side. Liquidity provision is ongoing, just at a lower level. They are continuing to expand M1 and M2. So you are facing higher rates, but they are supporting the problem of liquidity due to the fragility of the system. So that's our take. By the way, in terms of the importing inflation, so one of George's responses was to say the dollar devaluation will take over if the debt rates start to come down. So if debt gets held up in value, you deflate it by deflating the currency. This is the yen's game. And this is what we're seeing. We're seeing the currency go down. Why? Because the expectations of no more rate rises are in the hook. Labor is not as strong as it was. The rate of inflation climbing is lower when compared to a very high previous point. So the 10 years is 100 basis points below the federal funds rate, is what George is saying. How will they devalue the dollar? What are the mechanics involved? Well, the chart don't lie. The dollar is going down. Why? Because everyone, based on their models, every investment bank, every treasury of every corporate is seeing you're going to be doing all these things to keep increasing rates. You've got to bid because of that. You're fighting inflation. You're the most vigilant on inflation. Now you're more dovish than the ECB and the Bank of Japan for a nanosecond maybe, and the BOE. What ends up happening is people say, okay, these guys have gone dovish now. They've pivoted dovish. Time to out dollars and time to go this way. Japan, by the way, the yen super oversold for a while because it was a one-way runaway train. Now pulling back, one of the hardest. Swiss franc probably still the strongest for this period. We will get back into yen shorts. That game ain't over, but right now there's someone else who put their hand up to get ugly, and that's the dollar. So George, we are seeing the devaluation of the dollar by virtue of the FX markets. If you want to hold that debt up and bring those yields down, take it on your currency. Or talk more hawkishly, put up rates and have a stronger labor market number and come in higher than your expectations on CPI, all of which you failed. That's how they do. How do prices aggregate total go up via imports? Well, the currency devaluation sees inflation get re-imported. That's what we meant. The currency is going to go down. It already is going down. The dollar buys less steel, less agricultural foods, whatever you're importing. Triffin's dilemma is the holder of the base currency of the world exports dollars and imports goods, is a net consumer. You're consuming from China, which is one of the reasons why we shared the Chinese yuan with George, and we've just visited that chart. Which direction do you see it going? Well, ask me if I'm wrong. I see more down. I see down, more down, still to make a target. And we've had big secular moves with head and shoulders. One to reverse down and one lower down, quite further down. There was one to reverse back up. You've just reached your localized high with your biggest producer nation in the world that you are buying most of your stuff, ask Walmart, etc., using dollars. Now that dollar is going down in value, you need more of them to buy the same amount of goods from China. But then they'll say, oh, they'll stop buying, they'll buy from Mexico. Well, we show the Mexican chart as well in all of this. So if we follow this all the way down, you'll see George says he feels the Dixie is weak because the market believes Fed will droop. They are readjusting for expectations, in our opinion, in terms of the central banks, but they are also doing it based off the data that will give less opportunity for the Fed to hide behind the super hot labor market that clearly is not hot, especially as the data keeps showing it's no longer hot. So that is why the dollar will fall. That is why the dollar will fall. And we did the peso as well, which we also shared inside of all of that to show you this legendary currency. Now, it was a one-way ticket. Let's be frank, it's been a one-way ticket. The dollar has had an advantage of one-way ticketdom against certain producer nations. And this is the Mexican peso. Now, before I show you this chart in greater detail, I would actually like to get one of the bigger time frame ones. That's a weekly. This is the bi-weekly. This was the great trade that got away from me. The macro HVF. I actually got into this trade, and this was a sizing error. Take a lesson from someone who got something wrong. This was a major, deep in the sevens. I was working for a hedge fund, and I said, this thing's about to absolutely roll. I need the peso to be able to trade it, get it on Bank of America, Merrill Lynch. We're about to go through to, and I told them, 18 on the peso when we were down at 13. So that is literally a 50% failure in a currency. And what ended up happening is I used this smaller little, we call it a primer, setup within another setup. And it started to go, and I thought I was in the money. And it did one final dip back down, and it took out my stop. Now, as soon as it took out my stop, it crossed our funnel and ripped, and I was shaken out. And I went too big to make too much, and I couldn't get in again. They said, no, you spent too much on that one, you're not allowed back in. And that was the great trade that got away. It went away, it went away, it went away, it went away. Then you get the head, or the left shoulder, my apologies, the head, a blow off. When did that occur? You guessed it. I keep going back. Everybody doesn't understand. The March 2020 events was the seminal turning point of every major trend. This was your blow off into the dollar. This was the death of the peso. You went up to 26 on the peso. We are calling 14 to the downside and have done for a long time. This is a secular downturn. Mexican peso, you are getting labor done on Mexico. Maybe they're assembling your BMWs for US market or whatever the case may be. That US has existed in an environment where the major importers of goods have had, many of them, losing currencies. You've had the natural deflator in the fact that come back and buy later and it's cheaper in currency terms because that currency, Mexico, Brazilian real, are only going down against the dollar. Well, now you have the dark side of that moon. Their labor costs are going up in dollar terms, as in the Chinese yuan, and you will import inflation. So George's question, how do we import inflation? We don't get inflation. If you are Triffin's dilemma, throwing dollars into the world to create and provide enough to pay the dollar denominated debt and consuming goods, hoarding goods, then you have to be a buyer of those goods too. And if your currency's buying power goes down, you re-import the inflation. So inflation is very much like a train with a large amount of rubber in between them that's getting shunted. And you have 4 or 5 carriages. What actually happens is you get hit from behind with some force and it gets absorbed for a while and then it pushes the back carriage forward. That gets absorbed for a while to the next carriage and then it pushes to the next carriage. And you, the person, are in the locomotive. And all of these get absorbed and then later, right at the end, once all the rubber's been and the hit from behind is still coming, the runaway train that smacked you, you get suddenly shunted forward. So there's inherent delays, and then you hit the brakes and you hit the brakes and it has to slow down, it has to slow down, everything has to slow down. All that slowing down has to go back through the same rubber, expand its way back out, stretch out, all the way through the train that hit you from behind, all the way back down. It takes a while. Then as you start to slow down, the new force comes and hits and you start working. So it keeps coming in waves and there's delays. So everything America buys from the likes of Mexico, from China, is going to get more expensive if it's going to trade a 97 on the Dixie. European goods are going to get more expensive. In short, it is going to put a bid under the energies. Energies will get more expensive, particularly reference oil. It'll have a positive effect on natural gas because it's pointed. All the things that are priced in your currency are going to go up because the nation states that are producing them are often not you. And they need what they need in their currency. And at the moment, you're going down. You're going down against not just the majors, but you're going down against an emerging market currency. You're talking about the peso here, and we want it back. This is almost a round trip from the great mistrade of my 2015 year. I'm literally watching this turn into a round tripper. That's right, in the dollar. It's not quite. It will be around about 14.7. That's a run through 15. And that's immense. That's immense. Friend shoring, okay. But wow, guess what? That gift that allowed you all that wasteful money spent because your nation's suppliers were deflating their currency faster than you is now taken away. That's your future inflation. This is the key element, and these are the key trades. And that's what I mean in terms of George and his responses. So that is why we think he's calling time, and he's almost saying, I don't know if he's going so far as to say inflation's 1, but he's saying, nobody's seen this. We're back down at 3. It's almost like, hey, we've done the job. It's 2%. If they get it to 2%, which in a contracture environment and sub 2%, they'll all be cheering, but it's 2% against a much higher base rate. It's how they do it. And all that cost has been such a spike that it gave you such a surge that now you actually have a period of relapse, because now all the train carriages have been shunted, they're all moving and rolling, and now the rubber can slowly start stretching out, and the locomotive rolls easier, less friction, and so the carriages start to stretch out that rubber for a while before the next impact comes, and then it gets absorbed and transferred all the way along. That's kind of how economies work. So what's happening in the trades? This will come down for a while, it may even run that level. Longer run though, this is what we would call a continuation pattern on balance of probabilities. You're talking about the 10-year instrument. There is your seminal capitulation event in rates, which was a huge move up in the bonds, and everything of any major pause has turned out a continuation event, continuation event, continuation event. And guess what I'm guessing? Cup, rounded bottom, continuation event, key level at the 5. That's going to be your next move up. You move. Markets respect pegging levels. Remember, derivatives are based on key round numbers. Everything. So you are going to wind up for a while, and then you're going to move real quick. And that's exactly what we're seeing on the dollar index. Oh, so you're supporting your debt market now and bringing rates down. Okay, we kill the currency. We kill the currency because policy needs to be the destruction of debt, and it's also the destruction of money within that. That's why they have to keep easing. Anyway, so let's have a look at some of the other charts on the crosses there, and as to why we see it. So we'll show you let's go to the Swiss franc. We threatened the Swiss franc and have a look at that. While we're going past there, you can see it's not just the Swissy. I'm on the weekly here. Let's go daily. You can see what a big move that is for the Singapore dollar. You kind of had a triple top in there. There she goes, there she goes, there she goes, with a halfway bounce somewhere in there. That is a bad sell-off against the Sing. We consider the Singapore a future safe haven and a capital formation spot. We've spoken a lot about it. You've gone down against the CAD. You're selling off quite badly. That's on top of the Canadian that's been pretty strong for quite a while now. You know, break, test and spill. That is hard momentum to the downside. We talked about the USD knock. I'm in that one. It's an absolute beauty. It's a spill. It's a thriller. Of course, you've got a bit of an energy component in. This is the stretchiest candle, unlike the others. Wow, this is Wednesday, Tuesday, Monday, non-farm Friday. 1, 2, 3, 4. This is a beaut. This is a smackdown, and there's more to come. You're only 50% of the way to target if you don't continue any further as part and parcel of those head and shoulders. So this is weakness of the dollar. It is a key theme of weakness of the dollar. There's been a real adjustment to the downside in lieu of this particular event. What else did we do on this, the chart shares cuts that we did for ourselves during the course of the last few days? We highlighted. What have we got here? This was your Chinese that we suggested is rolling over, and you could see that. I think we've covered that one. This is your long-term dollar index, and I think we've covered that too. But a move to the other side, you're typically staying inside a range channel. You might actually break that channel to the downside. Sometimes we have what we call a basing ascending grind line, and that surrenders. It's possible. So remember, the target is 97, but it could overperform because it's the first structure of its kind in that time frame under review. So the dollar is really under stress, and this is what many people have to realize. So what does that do A lot of people getting a little bit excited about equities. So you've got the equity markets, they can afford to hold and even creep up in an environment like that, because the devaluation, we had a nice little squeezy Japanesey. We said in the last one, these are likely to go higher. You've got a gap open, but you've got a gap open in dollars that is weakening. This is putting a tailwind behind the equities. In the same way, we have called for 57,000 on the Nikkei with regards to upside. We are talking to you and saying this right here is going to put a tailwind under equities. We have a look at the VIX. What is the VIX looking like? Is it afraid or is it calm? It's going down. This is the equity volatility. There is peak confidence in stocks. Never mind the dollar, our stocks are going up. We don't have to mind. Have all your money in stocks and shares. Guess what? It could be dangerous at some point. But right now, with the dollar taking such a beating, it is the one that's taking the hammering for being deflated. And its debt is your largest concern. So actually, it's a bullish environment generally for equities on the whole. You can see it, the Russell was less bullish. Remember, you had the stock market going up largely on the Nifty 50. Look at this movement now on the Russell. Those are now getting some respect and some love to the upside, as you can see on this daily time frame. So nice little break to the upside, and again there was a structure in there. Ooh, squeeze, and then a deeper squeeze lower down, and you started to break out of the smaller one. You could in fact get some love back into the Russell in the market, but interest rates potentially being perceived as peaked are going to see some life come back into equities. However, if they suddenly turn, as we expect for the bonds to have all the 30 years and the 10 years turn back upwards at some point to try put an end to the pain, and I don't think it'll be suddenly. We need a 97 number on the Dixie. It's got some way to go before then, so I don't think it'll be tomorrow. I don't think it'll be next week. Maybe the rate of descent will slow for a while. You won't go there in straight line, but this is disorderly fast. This is disorderly fast, and it's generating some real alpha on FX trades against just about any currency as well. You know, against just about any currency. So we've shown you on the peso, we've shown you on others. So this brings us to gold. So gold started to turn, which is encouraging. Now we've said we think you're going to have a quiet August, September. September's when the end of August, maybe beginning, it may even take till the beginning of September before you get the upside you deserve on gold. And actually what started to happen is you are starting to get a little bit of love coming back into the precious metals. Not so much on the daily. Well, you can see it on the daily, but you can see that first there was a little bit of a reversal pattern structure in here. So again, as we draw it, nice little left shoulder, W head bottom. There's your right shoulder. The key number was 1930. It bugs me when they change it slightly. There we go. 1930 was the year, my friends. And there you are breaking up. You've got at least a 1967, and with, I would imagine, the 97 euro, excuse me. With the Dixie needing to get to 97, which is a combination of the euro and all the other components, I would imagine this goes well past there, because we've still got quite some way to go for that 97 run on the Dixie. And this has put a little bit of fun back into the gold market and put a little bit of joy back in. You revisited the top of this flag over here on the red dotted line. Now you're back above it. A nice strong reversal gets it back going again. So gold is getting invigorated from that pullback. You're starting to look like a little bit of a falling wedge structure that is broken now potentially to the upside, and with a target there. And as I say, if we go to the 97, I'd be shocked to find if we are not significantly approaching and potentially past the 2000 mark again. And the other part that's very important in precious metals, we're actually getting a bit of joy. Listen, when I said second half August, possibly when banks are back at their desks, September, That was predetermining that the dollar was going to turn around and throw it down this hard. The minute you get that, the God market of anti-fiat, the anti-dollar, is in fact gold, and it took a while to react. It simmered a little bit, and it wanted actually to be a bit weak. By the way, gold euro, totally different picture. Let me just show you these things. This is a dollar story. As I said last time, this is a dollar story, not a gold bull story. It's a dollar story. Yes, there's a little bit of gold bull because of the dollar story creeping in. But look at gold against the euro. Look at the difference. This is a dollar part of it. Yes, gold is the common element, but this is the dollar. Look, gold pound. Bleeding out. Again, because the dollar went down so disorderly, it started to get a bid. But this is off, quite long-term lows. You haven't been this low. You've just had your first two candles off a low right down at 1482. You've been a lot higher. It's very different appearance to that. It's a very different appearance indeed. And I mean, if we start comparing it to the Chinese currency, the yuan and renminbi, yep, you got a little bit of a breakout there. We shared that. Nice little one just triggered. You're going to go higher against them. But even if you have a look at it against the rand, it used to be a minor. Look at that. That's rand winning out over gold. This is gold, South African rand. How the hell does that happen? It's going down in rands, but it's going up at the same pace in dollars. So this is not across the board gold strength. This is dollar weakness. That's how serious this is. How many times do you look at gold and it's all about the gold? In actual fact, you look at gold and it's about the currency you're looking at it. It's flat on the Aussie. It's crashing against the rand, which is having a bit of a resurgence. And it's near lows and just having a small little first finger up. Many of those you've had before, only to be engulfed to the downside against the pound. However, I will highlight against the pound, it was allowed to make a new high. It never got that new high properly. 1651 on the pound, you were over here at 1579, you got a proper new high. Against the yen, you've been making new highs consistently with continuations. Beautifully on the monthly chart. So clearly on the daily, having just run another new target, you can have that pullback. So dollar weakness, it's a dollar weakness game, my friends, and this is what's putting a bit of a support, which is why it's been disappointing on the crypto markets. But I started to say I'd pivot to the gold-silver ratio to give you that take on silver. Silver started to get a little bit of action, and we got the gold-silver ratio coming down with some momentum, and we need that. We need that. Remind you of this chart. We need that. We want this baby right the way down to this fat red line, and then a small rally, and then to spill. That is the beginning. And we've continued to say this every dollar and every gold-based channel that we appear on, and there's many of them, we say we want 3 bounces here on this key red line, and then we are good to go. We need this down here. We have a final third one, and then when we let this baby go, we're going to be hard and fast. We might bounce a little bit on that funnel, but it'll be pretty brutal to the downside there. This is your concern with the dollars that have been created, and your Ukraine and your everything else story. You cannot waste money on all these boondoggles, cluster bombs. Giving your cluster bombs away. How kind, how nice. What a lovely thing to give. But yeah, so that is it. We're back down to this neckline, and that will be a substantial move. When will this moment be? Well, we've said back end of August, September. But if the dollar continues to lose at such a rapid rate, we're only the mid-July. If it continues to lose, comes down here, gets a short bounce in there, you could see that this could in fact happen a little quicker. So, we'll see. So that is a major acceleration. This is your video. Thanks for watching. Remember, you can join us on the other pairs that we've taken short on this one. One of our favorites that you can see now was the USD Swiss franc. I did threaten to show that to you, so I must finish on that. USD Swiss franc, and currently I would argue of all the fiats, probably the most sound by price performance. Many people find it hard, but boy, what a throwdown that is. What a throwdown that is. You can see it in real time It is ruthless. It is absolutely ruthless. Down, down, down. Look at that grind. This is a throwdown of note. So you were in and around the 89s, 0.9s and 90s there on non-farm, and you're down at 86, 80s at the moment. So this is a very hard, we're on the daily time frame. It's a very hard sell-off. We actually have a setup on there. You can come and see that setup and the targets that are implied by it. Click that first link below in the description. You can see where we expect the USD Swiss franc to make a target. Thank you for support. Thank you for hitting the like button and your subscriptions. That is our take on why one or the other must happen. And I think after the dollar's gone down hard and fast for a while, we'll go back to rate increases. That's right, on the bond market. The bond market will get some temporary release. So there's two release valves. And at the moment, that rate climbing, 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 and the expectation of inflation, strong labor, and of course rates increases suddenly disappearing has led to a real adjustment. And now America is in the situation that the British were in when their pensions went illiquid on account of bond rate prices escalating. Now they must experience it too. If they want to bring those rates down and keep a bid in the bond market, the currency must go. That is the Japanese yen dilemma, and so many nations are in it. We are going to build our wealth trading these trapped Ponzi schemes of different nation states, one after another, into real freedom and real financial wealth during this reset period. If you can see that and want to be part of that, first link below in the description. Come and join us, and we'll see you on the other side. Thanks for watching.